Good afternoon. Welcome to our first Employment Taxes webinar. I'm Kathy Lloyd, an Employment Taxes Director here at James Cooper, and I'm joined today by my colleague Kate Pollinger as a Senior Manager in our Employment Taxes team too. Kate and I are delighted to have you join us today for our first Employment Tax update. A couple of bits and pieces just to walk through. Next slide. Housekeeping, Kate and I are both in the office today to kind of make these things work. We are not expecting a fire drill or test today. So if the alarm does sound, unfortunately, we will be down tools and we will have to follow procedures in the office. In terms of the format for today, we've got half an hour dedicated to, a canter through what to expect on employment taxes. But we've also got some dedicated time for Q&As at the end. Equally, we're happy to field Q&As as we go through. So please do ask your questions. You'll see on the bottom of your screen, there's a dedicated Q&A radio box at the bottom. It's the fifth one across. If you pop your questions in there, then Kate and I would be pleased to pick those up as we go through. That completes the housekeeping. So let's take a look at what Kate will be covering today. So we thought that we'd start with the changes that are pretty much imminent, everything that is on the cards basically for April 25 and onwards. Then we thought we'd delve into those changes that we know are a little bit further afield, April 26. We thought it was important that we talk about these changes today, even though they feel slightly in the distance. Considering one of those big ticket items is payrolling and benefits, there's a lot of planning to be done around that. So we thought it'd be appropriate if we brought that to the session today. We thought that we'd touch on some opportunities, again, kind of cost saving, salary sacrifice, those sorts of things, but also, again, delving a little bit into the payrolling of benefits and what you can be doing right now to try and get yourself in the best place as we await guidance from the revenue. We will then look at what we see in the market as hot topics. This is in our experience. This is based on our client work that we are doing at the moment, but equally also our work and relationship with HMRC, what we expect them to be focusing on this year and beyond. And then Kate will wrap up at the end with a quick canter through the key compliance deadlines and obligations. So without further ado, I will now hand you over to Kate, who will kick off talking about national insurance in 2025 and what we can expect.
Thank you very much, Kathy. So first of all, I'm going to talk through the changes that are happening imminently in national insurance for employers from this April, so from the 6th of April 2025, not very far away. You probably saw the headlines when this was announced last year. First of all, the employer national insurance rate is going to increase to 15% from 13.8%. And the threshold at which employers start paying NIC on an employee's pay will go from £9,100 down to £5,000. The good news is that the employment allowance, which is set against the first tranche of an employer's national insurance, will go from £5,000 to £10,500. And many employees that couldn't claim it currently will be able to claim the employment allowance after April 25. Currently, if an employer's national insurance bill in the previous tax year was more than £100,000, or if they were in receipt of certain state aid, the employment allowance was either reduced or not available to them. That restriction has gone. Many more employers will be able to claim it, but the group restriction still is in place. So if your business is part of a group, only one group company can claim the employment allowance, or you can spread it across the group, but you can only claim it once. The upshot is this is an increase in national insurance for about 1 million employers.
I think the one thing I would add there is obviously the increase in national insurance will also apply to Class 1B and Class 1A on staff benefits. So that will start applying from April 25 onwards. And as you said, Kate, you've mentioned there around claiming the employment allowance. Many businesses, as you say, were taken out of scope in recent years, but many of our clients will now kind of be finding themselves back in scope around being able to claim that employment allowance. And again, I think in our experience, it would be fair to say that we see where there has been a change in the business. So if you was once claiming the employment allowance before you kind of literally instruct payroll, put that back through the RTI and the EPS, just step back and ask yourself, has there been any changes to the group structure or ownership, which then pulls us into the group and the connected company rules? Absolutely, Kate. Good stuff.
And also, if previously you couldn't claim it, then you got big enough that your NIC was over 100,000, so you couldn't claim it. Check whether you can now claim it again if you've got out of the habit of claiming it. Definitely. Thank you. The next point is in relation to double cab pickups. This was proposed by the previous government. Then they changed their mind very quickly, but the current government has picked it up. What I mean by double cab pickup, actually the HMRC definition is a vehicle with 2 rows of seats, 4 doors, and then an open area at the back for tools, equipment, that sort of thing. But they are quite trendy, and you do see quite a lot of them on the roads out there. The typical example would be a Ford Ranger, that sort of thing. You see them everywhere. And if one of these vehicles has a payload of more than a tonne, then they're going to be treated for benefit in kind purposes as cars from April 2025. It's not going to be a sort of cliff or edge. These vehicles change overnight. What's going to happen is there are transitional rules up to April 29. So if a business has bought or leased one of these vehicles and signed on the dotted line before April 25, then they can use that vehicle and continue to treat it as a van up until the end of the lease when the vehicle's sold, or April 2029 if the business is still using it then. So why is this important? Well, vans are much more cheaply taxed on the employee as a van and not a car. Vans are taxed on a flat rate of £4,020. So that's the benefit in kind value. And if that van also comes with private fuel, then that's a flat rate of £769. Cars can give a much higher benefit in kind charge, which is based on the list price multiplied by a percentage, which is based on the vehicle's CO2 emissions. And that percentage can be up to 38% of the list price of the car. For fuel, you take that same percentage, up to 38%, and multiply it by a fixed value of £28,200. The other difference between cars and vans is that as soon as you allocate a company car to an individual and they can use it privately, there is a benefit in kind charge. As soon as you give them a little bit of private fuel, there's the fuel scale charge. For vans, it's slightly more generous. Vans can be taken home at night, and limited incidental private use is fine before you get the van scale charge. So the rules are more generous in sort of getting out of the benefit in kind charge if it's a van compared to a car. If you have a fleet of these vehicles, then the cost of this reallocation from vans to cars is going to be very expensive. I outlined the numbers before, but as an example, a typical double cab pickup with a list price of £37,000 will result in an increase in tax for the individual of £8,000 per year if they're a high rate taxpayer, and the company's NIC bill will be an extra £3,000 per year. So it's a big change if you are thinking about taking delivery or providing these vehicles to your employees. Another change, which was proposed, was increased information needed on employee pay slips. This was with a view to HMRC being able to identify national minimum wage issues quite quickly and easily from the pay slip. This was proposed, and then a short while ago, those changes were cancelled. So I was going to talk to you about that. I don't have to anymore. If you were concerned about it, it's gone away. Whether that's temporary or permanent, we don't know. But right now, it's not something we're going to have to worry about.
And again, Kate, I think, when we look at what is on our clients' and employers' landscape, the government has committed at this stage that payroll and benefits will come in from 2026. We have the Employment Rights Bill, tracking alongside of this, and this is all kind of out for consultation, etc. I actually think the revenue and the government pausing on the additional information on payslip design and information is welcome for business, because I think that's, in my own experience, I think this is where sometimes the government and HMRC are not fully abreast of the demands and the admin compliance that comes with all of those things. So yeah, I think that's a welcome U-turn at this stage, but again, watch this space with the Low Pay Commission and their agenda.
Exactly.
Next slide, please. Thank you.
Yes, absolutely what Kathy said. The changes that are planned in the next year, particularly in respect to payrolling of benefits, is massive. A big onus being transferred to the employer in accounting for benefits in kind in real time on a monthly basis. So what is payroll and benefits in kind? So at the moment, benefits in kind, so your cars, your private medical, loans, whatever, are put on a P11D. At the end of the tax year, that's submitted to HMRC. You pay the Class 1A national insurance in July, and then individuals pay the tax on their P11D benefits either via self-assessment or an adjustment to their tax code. The idea is that forms P11D will be disappearing. So we have this year, to April 25, you'll need to do forms P11D. And for another year, there will be forms P11D, but from April 26, payrolling benefits is going to be mandatory as it stands. What does it mean? It means that you take the value of the benefit in kind and you add it to the employee's pay on a monthly basis for tax, but not national insurance. You may be doing that currently voluntarily. It's been available for a few years now, and you may already be experiencing complications when you do it. But at the moment, as it's voluntary, you can you have the opportunity at the end of the year to do sort of reconciliation and mop up and make sure the right things happened. But from April 26, it will be compulsory. At the moment, you are not allowed voluntarily to payroll, loans and accommodation. From April 26, this is another area HMRC have sort of kicked into the long grass, because rather than making it compulsory from April 26, they've said you can do it from April 26, but it's not compulsory. I put on the screen PLMDB still needed. We think not. We think that Class 1A national insurance is going to be paid in real time. This means employers will be paying on a monthly basis, the Class 1A, the payment that they were used to paying after the end of the tax year. As we've alluded, these rules aren't finalised yet. We haven't had the legislation. We're expecting guidance this summer. That doesn't give employers very long to put this in place by next April. And just last week, there was a very lengthy representation from the Institute of Chartered Accountants to HMRC saying, have you thought about these consequences, these complications? What about expats? What about leavers? All these questions that the guidance so far hasn't covered. So we're waiting for further guidance, and we anticipate it, and employers need to plan for this change. But we will see what happens later this year. But it is something definitely you should be aware of, and you may already be doing. Another proposed change from April 26 won't affect many employers, but it's in relation to IR35 and umbrella companies. There is a perception that that umbrella companies have been used to avoid tax and national insurance. There have been a few cases recently where umbrella companies were found not to be accounting for the correct amount of tax and national insurance. They'd been making deductions that they shouldn't have been and not paying the right amount to HMRC. Companies used umbrella companies because they promised to take the compliance off them. So the end client, the user of the individual services, wasn't having to do all this compliance. But there was this perception from HMRC that there was a tax avoidance in this area. So HMRC intends to move the obligation to account for PAYE and NIC from the umbrella company up the supply chain to the agency, if there is one, or if there isn't an agency, then the end client, the business that's using the services of the individual. So if you are in this situation, it's extremely important that you examine your supply chain. Are you in this situation? Where is the obligation to account for PAYE, NIC? Are you, as the end user, doing what you have to make sure that you're not going to suffer any penalties as a result of non-compliance, that in your supply chain, the right entity is dealing with this obligation?
Yeah, absolutely, Kate. And, I think when we touch on contingent labour, it's absolutely critical to the success of the UK labour market, and is critical for business, right? We can't always have full-time employees doing all of the tasks that need doing. And obviously, in mine and Kate's experience, each year we see the revenue and the government trying to chip away at their belief of the loss of tax and national insurance to the exchequer, where people are just not on the payroll. For me, it's quite interesting because in the UK we do have a concept of self-employment. Some countries, a lot of countries out there, do not have a concept of self-employment. So again, we are seeing a raft of kind of almost what I would suggest a little bit kind of sticky plaster type measures from the government to try and plug a hole. I think, whether it's IR35, whether, you're dealing with agency workers, umbrella, employment status with sole traders. For me, I think actually, Kate, the point you made there around supply chain due diligence. Do you know who you are engaging with, and do you know who they are engaging with? Because in my experience, there's lots of umbrella companies out there, there's lots of agencies out there, there's lots of businesses all doing the right thing. What we tend to see where the risks arise, which is where you as employers should focus, is where you have complex and convoluted supply chains. That is normally a red flag that perhaps something is not quite as it should be. So I think actually, Kate, to sum that up, supply chain due diligence, who are you engaging with? But equally, who are they then engaging with, and how long does that engagement labour supply chain look like? Because this is going to continue to be an area of focus from the government and HMRC for sure. Next slide. We've got no questions at this stage, so please do send them across. But next slide. Fab.
Thank you. So a couple of opportunities now. The first one is quite a hot topic at the moment, given the proposed increase in employer national insurance. Salary sacrifice has been around for a long time now. HMRC started calling it optional remuneration arrangements, OPRA, a few years ago. I'm going to use salary sacrifice just for now, it's the term that we're most used to. So what is salary sacrifice? It's salary sacrifice arrangement is where an employee's pay for tax and for PAYE and NIC is reduced. And in return for a reduction in their taxable nickable pay, the employee receives a benefit in kind. So done properly, the company and the employer and the individual are immediately saving tax and national insurance on that salary given up. If, as a result of the salary given up, the individual is provided with additional pension contributions, bike to work, an electric vehicle, or a workplace nursery, then that's the most tax efficient arrangement you can have, because those four benefits in kind are not taxable. The individual has given up taxable salary and received a tax-free, or in the case of electric vehicle, a small taxable benefit in kind. If the individual is provided with anything else, then HMRC will tax the hire of the salary given up and the provision of the benefit in kind. This also includes benefits in kind that are which, if they were provided outside a salary sacrifice, would be tax-free. For instance, an employer-provided mobile phone. If you provide your employee with a company mobile phone, there is no benefit in kind, subject to not excessive personal use. If you provide that mobile phone under a salary sacrifice arrangement, that mobile phone becomes taxable. HMRC will tax the hire of the cost of providing that phone and the salary given up, which sounds very bizarre, but this is the intention. This was HMRC's intention. It's not a mistake. It is repeated all throughout HMRC guidance that is the situation. As I said, the only tax efficient benefits that can be provided under a salary sacrifice: pension contributions, bike to work, an electric vehicle which has a very low tax charge, or a workplace nursery. As an example of the tax savings, if an employer has 30 employees, each earning on average £30,000, and they make just the absolute statutory minimum under auto-enrolment pension contributions, by doing a salary sacrifice, that employer could save £5,000 a year just in national insurance. The employees are saving national insurance too, and they're getting upfront tax relief on their pension contributions. A couple of things to flag. One is national minimum wage. If somebody's paid around the national minimum wage, you can't sacrifice salary below that. There's no exemption from the national minimum wage if you're doing one of these sacrifices. The other point is that we're dealing with a legal change to somebody's terms and conditions. This is something you need to take advice on. And there are also quite complex rules about the timing of the sacrifice when it comes to the tax rules as well. It's not something that can be done quickly and easily. It's something you could take advice on, you should take advice on, but giving the savings, it doesn't take many years to recover those implementation costs for a successful salary sacrifice scheme. And we are seeing more inquiries from our clients on this, especially in light of the NIC increases.
Absolutely, Kate. I think salary sacrifice, strapline would be devil is in the detail in terms of operationally. I think a couple of other potential benefits that we see across salary sacrifice would be holiday, buying and selling annual leave. That is always popular as well from an employee relations perspective. Invariably, if you give staff an opportunity to perhaps buy an additional 5 days leave, the work still always gets done. So and that has been tried and tested over the years. And then the other one that we do see, this one isn't as popular, but we'll see now with the change in national insurance and people's appetite, bonus sacrificing as well. But again, with careful planning, all of those things can come through into a solid salary sacrifice policy and operational day-to-day to bring all that together for you. Yeah,
absolutely. Thank you. We've mentioned the mandatory payrolling of benefits from this time next year. Many employers are doing it, are having a test run at it, either already doing it or implementing it from this April for a year before it becomes compulsory. The reason they're doing that is to test their systems and procedures, test where they get their information from, how that is fed to payroll, how you deal with leavers, joiners, what happens when your private medical insurance policy is renewed in October, how you deal with that. And that's a great idea to give you a year to test how this is going to work before it comes compulsory. But I must say, if you are going to think about that, you must tell HMRC before the start of the tax year, and the sooner the better. You cannot do it without registering with HMRC, and the sooner you do it, the better, because if you leave it to the last minute, HMRC won't have time to change people's tax codes. There would be a real risk that when the PLMDs go in, HMRC add the benefits in kind to their tax code, and at the same time, you're taxing individuals on a real-time basis on their in-year benefits in kind. So people are being taxed twice. HMRC have said that if you go online, request to register, tell them who is going to be payrolled and what is going to be payrolled, they will adjust tax codes. But obviously, the longer you can give HMRC to do that, the better. And also, you need to tell your employees that this is going to happen, because they will suddenly notice their pay dropping in April. And also, employees need the tools to understand how their tax code has changed, why it's changed. Obviously, you can't do that for everybody, but it's reasonably simple to point them in direction of where they can find the guidance on HMRC websites and contact HMRC if there's an error. The longer you can give them to do that, the better. As I said earlier, you cannot at the moment payroll loans and accommodation, and that's where we are at the moment. If anyone is considering doing that for 25, 26, if you don't, PLMDs as normal up to April 25, PLMDs as normal up to April 26.
Thanks, Kate. Just one thing actually that we've seen a fair bit ourselves crossing our desks at the moment is actually salary sacrifice for workplace nurseries. Again, the devil's in the detail as to whether a workplace nursery is qualifying for tax and national insurance, and therefore you as an employer is actually then kind of benefiting from the tax efficiency of those. Just to let you know, we are seeing an uptick in workplace nursery schemes being provided. That is definitely something you should be taking tax advice on, because many of the schemes actually do not fulfill the exemptions and the clauses that are attached to those. So yeah, just one thing to add there.
Yeah,
next slide.
Yeah. We're on the next slide, it's fine. No, thank you. Yeah, absolutely, very relevant. I skipped over workplace nurseries, but the legislation says workplace nurseries. A lot of organisations out there have implemented and offered our clients these schemes, which, when you drill down, we don't think they fulfil the requirements. So hot topics. I think since COVID, we've seen an upturn in HMRC activity. They are coming out to our clients more. They are conducting broad range compliance reviews or focused reviews into areas like minimum wage and IR35. At the moment, immediately post-COVID, the reviews were mainly around CJRS and furlough claims. But as HMRC can go back 6 years, those are still part of a review now. If a HMRC was to visit you now, looking back 6 years, those claims are still within scope, and it is quite a lucrative area for HMRC to look at general compliance and CJRS in one go, and they are seeing quite a high return on their investment in this area. Also, the rules of the benefit and the travel rules have changed quite a lot since COVID. Some emergency rules were brought in during COVID about employee travel and home working and that sort of thing, which have now gone back to the previous rules, and many employers still think it's okay to provide certain things they were providing COVID, which now the rules have changed. Could give rise to a tax liability. So just let you know, HMRC's out there. If you haven't had a knock on the door for a while, that doesn't mean to say you won't. And one thing we would say is, if you are thinking about it, if there's an area you think you're exposed in, rather than waiting for HMRC to come and find it, if you take it to them, there will invariably be lower penalties imposed as a result of you taking it to them. And you are also then managing the process rather than waiting for HMRC to come out to you. Another area we see time and time again is directors' loan accounts. So you're probably aware, if you provide an employee with a loan of more than £10,000 and they don't reimburse the company, the employer, at a rate of higher than the HMRC interest rate, which is currently 2.25%, then that loan has to go on a Form PLMD at the end of the tax year. Many employers and many companies don't realise that also applies to overdrawn directors' loan accounts. So if a director has an overdrawn loan account by more than £10,000 at any point in the tax year, then the director must pay the company interest at 2.25%. We see time and time again that interest is either added to the loan or just added to the director's loan account. HMRC's do not consider that as paid. For the interest to be paid, it must physically be paid to the company or included in the calculation of a dividend paid to the director. We have recent experience of HMRC approaching clients, raising assessments on in failure to file a P11D where a director's loan account was overdrawn and the interest was rolled up, basically added to the loan rather than actually paid by the director. Another area constantly on HMRC's site is national minimum wage. It's been around since 1999. There's quite a big hike in the rate from this April to 12.39%, with the view potentially in the future of eliminating the age band so it is a flat rate for everybody of 12.39%. Payroll software now starts shouting at you as soon as you pay somebody less than that. But there's all the other areas around minimum wage that could trip up companies. So do your employees on the minimum wage have to provide uniforms? Do they have to provide tools? Are they required to turn up at work, get changed, set up their workstation before they officially clock on at 8:30, 9 o'clock? Does the same thing happen at the end of the day? Is there a salary sacrifice arrangement that could impact this? Those are the areas that HMRC will examine when it comes to minimum wage, and the penalties are substantial for a failure. Not only are the financial penalties of 300% of the underpayment, up to £20,000 per person, but there's also the bigger risk for many organisations is the naming and shaming. The government published lists of employers that have failed to comply with the minimum wage rules, and journalists love looking through those lists and splashing companies all over the headlines that have fallen foul of these rules. HMRC can go back 6 years. Another area that they're looking at, and it is a quite an area where they see a lot of non-compliance. I've mentioned status. Kathy and I have mentioned status of payroll working in IR35. The fundamental rules about whether somebody's an employee or not haven't changed. In the situation where somebody is self-employed, you look at that relationship to say, should they actually be on your payroll? If somebody's presenting via a personal service company, you look at the same rules to determine should that individual be on your payroll or potentially on the payroll of their personal service company. The rules, or as we said earlier, in the supply chain, is there an umbrella company or is there an agency that should be applying PAYE and NIC? The basic tests have been around forever. Is the individual required to provide services personally, or can they send a substitute? Does the end client, the engaging company, have control over where, when, and how they perform their duties? Is there an obligation to provide them with work, and an obligation on the individual to do the work provided to them? And there are various other tests as well. Those are the key tests that are applied in the self-employed situation and the IR35 situation, the situation where there is a personal service company. There are a couple of changes in the since the IR35 came in 2000, but changed in 2017 and 2021. But it still remains the end client's obligation, the user of those services. It's their obligation to work out, is that person within IR35? Does that organisation have the obligation to account for PAYE and NIC? Or is it an organisation further down the supply chain? But ultimately, it's the end client that has to do this. It's you, the engaging company that's using the services of this person, who has to test the relationship to see, is it inside IR35 or not? HMRC have published a tool called the CEST, Check Employment Status Tool, on their website to where you can put in the, it is multiple choice. So it will ask a question, 4 possible answers. You have to choose the answer that's closest. And at the end of it, it'll give you a determination inside or outside R35, employed or self-employed, or then another answer is not enough information to determine. HMRC have said that if you answer those questions, obviously, honestly, you can then file that document as your defence that you have carried out the correct procedure, got the correct determination, and you've relied on it. what often happens is 6 months down the line, situations change. Their duties have changed. Their hours of work have changed. They're now effectively sitting alongside your employees, working on exactly the same basis as other employees. That CESS tool that you did 6 months ago is no longer valid. The situation has changed. You need to review it again. You need to keep it under review, as this is a very hot topic with HMRC. And again, we're seeing many tax tribunal cases on this subject. HMRC are looking at this area, especially when it comes to high-profile names, and examining these tests time and time again. It is a very, very hot topic. I put company cars and fuel as surely what's contentious here. But again, we are frequently asked by our clients, or we're advised by our colleagues, oh, this organisation has a car. Do you think they have to report it? There's a fine line between a company car and a pool car. But most of the time when we look at the situation, it's not a pool car, it is a company car. It should go on somebody's P11D. Some of the confusion might have arisen because a few years ago, there was a nil benefit in kind on an electric vehicle. That is now 2% and it's going up to 8% in the next few years. So company cars, if there are cars out there, people are driving them home, people have exclusive use of them, and employees can use them, are able to use them privately. Chances are it needs reporting. Potentially there could be a fuel benefit in kind charge as well. So it's one of those situations. Please feel free to let us know, and we can talk through any reporting you might need to do on that car.
Thanks, Kate. It's quite a lot of hot topics there. But you know, again, I think over the years, you know, do these hot topics really kind of shift and move too much? You know, they pretty much, you know, these are always the revenues kind of targeted areas. And I think the one thing that's been quite interesting for me in the last kind of 5 years of my career, I've been a lot more involved in company startups and also M&A work, where you're spinning out or carving out, or you know, mergers and acquisitions. And you know, if your company's kind of within any phases of that aspects of planning, again, these all tend to be hot topic areas, whether you're, you know, in startup, spin out, or carve out. So you know, there's kind of a couple of aspects here. And again, the one thing that the new Labour government has announced as part of the budget in the latter part of 2024 was their commitment to actually increase their compliance officers across all aspects of taxes. There were some stats that have been released recently whereby their kind of collection from compliance reviews is down. So, you know, whilst they're still out on strike at the moment, which isn't, you know, fantastic given self-assessment season and preparation for, you know, the new tax year, on the other hand, we are then hearing, you know, the revenue and the government are fully committed to upskilling and increasing the bandwidth of employer compliance officers. One thing on national minimum wage, I don't have a crystal ball, but it's been some time as well since there's been a naming and shaming list. So I wouldn't be surprised if we have the latest naming and shaming list for national minimum wage breaches, probably, I would suspect, certainly before the start of the new tax year. So yes, Kate, these are all kind of, you know, hot topics for the revenue, hot topics for our clients, and where there's any change in the business as well, Fab.
Fantastic, thank you. So next slide. So very quick canter through compliance, because I know there are questions which we want to come to at the end. So forms P11D, you should be very familiar with those. Therefore, reporting your cars, your private medical, tax return preparation fees paid for on behalf of a director, loans, accommodation, that sort of thing. Only for 2 more years, allegedly, only 24, 25 and 25, 26. you can no longer send paper copies. It has to be done online. You can actually, if a PLMD has gone in the past that's wrong, you can actually amend it online through your gateway through HMRC. And that I've done that on behalf of clients. It's reasonably straightforward, but no sending paper copies into them. And also for the next 2 years, paying your Class 1B, Class 1A after the end of the tax year, but in July on the benefits in kind on your Form P11D. PSA, a PAY settlement agreement, that's an agreement with HMRC to pay tax on behalf of employees on minor, irregular, or benefits where it's impractical to work out the value or to allocate it to a particular individual. It can't include large items like cars, cash, and loans. It's there for things like staff entertainment over and above the annual event exemption, gifts, rewards, taxable travel, that sort of thing. You have to apply for the PSA by the 6th of July, so it aligns with the P11D deadline. Agree it with HMRC. You've then got until October to provide them with the calculation. There are certain items that don't have to go in a PSA, trivial benefits, workplace parking, refreshments in the office, employer-provided mobiles, long service awards. So long that each of those have quite strict criteria, but we're quite often given data by our clients for a PSA, and we can strip out quite a lot of items because they're not taxable, unless, of course, they're provided under a salary sacrifice arrangement, in which case they are. So just be aware of that. And if you think you need a PSA or want us to help you with the calculation, we'd be very happy to do that. Quick word on employment-related securities. So employers must comply with employment-related securities or ERS reporting by submitting an annual return to HMRC for all share schemes, including tax-advantaged and non-tax-advantaged plans. What you have to register a scheme with HMRC and record all transactions like share options, awards, at vesting exercise, and submit a return to HMRC each year. Companies are obligated to report these transactions to ensure tax compliance, including information on share options, benefits derived, and how they're taxed. Even if nothing happens in the year, a nil return is required, and there is a fee for failing to submit a return on time. Sorry, there is a penalty for failing to submit a return on time. The next slide is just the next slide is just a reminder of the deadlines. I won't go through them as we have questions, but those are the sort of those are the deadlines to bear in mind for compliance for next year, for reporting P11Ds and PSAs until, of course, the requirement to complete a P11D will be removed in a couple of years' time. So, Kathy.
Thanks, Kate. That's absolutely brilliant. And you are literally near enough right on time, which is just a miracle as well. So super credit to you.
Okay,
I think I've had the easy bit. I'm not quite sure, but obviously I've been looking at questions and some bits and pieces, and we have had a couple of questions in, but they've been very kind of client specific. So I've actually agreed to take those questions offline later. Okay. So, so I think all we have to say at this stage is thank you all for joining us today. If if we've gone through anything today and it's, you're kind of thinking about, what the future might look like and have any questions, please do not hesitate, to get in touch. We are here to help. Share our experiences, share our knowledge, and we'd be delighted to pick up on anything you'd like to discuss. So have a great day, everyone. And as I say, thank you for joining.
Thank you very much. Thank you.